Welcome back, folks. So, inflation strikes back. May 2026 CPI inflation report that came out last week, and it's not good news. Inflation came back at 4.2%, its highest since 2023, with personal consumption expenditure coming at 4.1 for May 2026. So, PCE, the personal consumption expenditure, has been steadily rising since February 2026 with the start of a needless, totally unnecessary war with Iran, taking PCE inflation from its low of 2.9%, steadily rising to a whopping 4.1%. So when compared to inflation exactly 12 months ago in May 2025, we were at 2.4% inflation, and now it has catapulted to almost 4.2%. And driving this drastic rise in inflation have been the energy and fuel prices, like you must have guessed already, with energy prices rising about 23% and fuel prices up 40% versus 12 months ago. So if we take a quick look at the energy breakdown, it reveals that energy commodities went up 40%, gasoline went up 40%, and fuel oils went up 40%. No surprise there. Here's another chart to further drive home the point how energy prices drove inflationary pressures in May 2026 versus a year ago. So what this means is that the purchasing power of our dollar is dropping steadily versus May 2021. $100 back then is equal to roughly about $124 today. That's a dollar value depreciation of 24% over 60 months. So this further increases pressure and focus on what Kevin Warsh will do or is planning to do in his moves forward. So Mohammed El-Erian, a reputed financial guru in the financial markets of the US and Wall Street, in a recently given interview, supported Kevin's move to create these 5 task forces that he has created in order to take the overly excessive dependence of the financial markets on what the Fed is going to say over to a more objective, data-driven environment in which financial markets react to and adjust their decision-making based on what financial data they see themselves, that they're experiencing in the real world, instead of reacting to what each Federal Reserve meeting press conference has to say. So let's listen into Mr. Erian, and then we'll come back.
And so perhaps that supports your view that the Fed doesn't do anything in the meantime, but it also means the market has to sort of keep wondering, right?
Yeah, and I think that what Kevin Walsh is trying to do, and I think it's the absolutely right thing, is break this very unhealthy interdependency that developed between the markets and the Fed. And it resulted in the Fed seeing its room for maneuver reduced. That's not a good thing. And it resulted in the markets being very data dependent, very short term. Mm-hmm. And we've seen significant changes in expectations of rate hikes. I think breaking that interdependence is in the interest of the economy longer term.
There's a lot of
So as of today, the probability of Fed rate changes per CME Fed Watch tool is at a 29% and steadily rising in favor of a 25 basis point rate increase at the July meeting. Quick look at the chart. So if you are a buyer looking to buy a home, now is the time. The interest rates are not going to go down anytime soon. Actually, it's going to the opposite direction the way things are looking. So once again, this is Basir Pirzada, your real estate broker and your mortgage loan broker, all one-stop shop. Please like, share, subscribe. We'll bring you more news as it becomes available. Thank you for watching.